In the last few years, artificial intelligence stopped being just another tech sector. It became a force of nature, shaping markets, government policy, and corporate strategy all at once. Entire industries are now rebuilding themselves around AI roadmaps, often years before the technology has even proven it can reliably deliver what's being promised. At the very heart of this transformation sits a small group of companies, but one name appears more than any other: OpenAI. To its supporters, OpenAI represents human progress, a company pushing the boundaries of intelligence itself, unlocking productivity, creativity, and economic growth on a scale rarely seen before. But to its critics, OpenAI represents something far less inspiring: a dangerous imbalance between ambition, financial reality, and systemic risk. What makes OpenAI so unique isn't just its technology. It's the sheer scale of trust the global market has placed in it. This isn't just a vote of confidence. It's trust that is translated into spending commitments measured in the trillions of dollars across data centers, chips, energy infrastructure, and financial leverage. And that's where the story starts to become unsettling.
OpenAI earns billions of dollars each year. By almost any historical standard, that would make it one of the most successful tech startups ever created. But when you compare those revenues to its spending trajectory, they begin to look almost irrelevant. The company is burning through capital at a rate rarely seen outside of wartime economies or massive government megaprojects. Normally, this is where the system applies pressure. Investors push back. Boards demand discipline. Lenders tighten conditions. Growth slows. But with OpenAI, that pressure has barely materialized. And the reason is both simple and profoundly disturbing. OpenAI has managed to separate the use of resources from the ownership of risk. Instead of directly funding its enormous infrastructure needs, it has convinced its partners to do it on its behalf. Cloud providers build entire data center campuses. Chip manufacturers expand multi-year production lines. Energy companies invest in power generation capacity. Banks and institutions provide the financing. In many cases, OpenAI pays later or doesn't pay directly at all. This creates a structure where OpenAI enjoys what looks like unlimited access to capital and infrastructure, while much of the downside risk sits somewhere else. Not on OpenAI's balance sheet, but on the balance sheets of its partners, lenders, and ultimately, the broader financial system. For now, this arrangement works because it's held together by one thing: belief. Belief that AI demand will continue to explode. Belief that OpenAI will remain dominant. Belief that future profits will be so large they'll justify today's extraordinary excesses. But belief is not a business model. It's a narrative, and narratives are fragile. Technologically, OpenAI's position is no longer as secure as it once appeared. When ChatGPT first launched, it shocked the world. Competitors were caught flat-footed. Markets reacted emotionally. OpenAI wasn't treated as a leader, it was treated as an inevitability. But that moment is past. Rivals have caught up. In some cases, they've moved ahead. Advanced models from Google, Anthropic, and xAI now compete directly on reasoning, speed, multimodal capabilities, and enterprise integration. The massive technological gap that once justified OpenAI's extraordinary valuation has narrowed significantly. Yet, the financial commitments tied to OpenAI have only grown larger. This mismatch between competitive reality and financial expectations is the real danger. Markets are willing to tolerate losses when leadership is clear and uncontested. They become far less forgiving when dominance erodes while spending accelerates. The infrastructure being built today assumes a future where OpenAI's demand rises smoothly, endlessly, and without disruption. But data centers are long-lived assets. Chip fabs take years, sometimes decades, to pay off. Energy investments cannot be unwound overnight. If OpenAI slows down, pivots its strategy, or loses meaningful market share, those costs don't vanish. They remain fixed, heavy, and often financed with debt. This is where company-level risk turns into systemic risk. Financial analysts increasingly describe the AI sector not as a collection of independent companies, but as a tightly coupled system. A slowdown at one central node, like OpenAI, could ripple outward. Suppliers take losses, lenders face defaults, equity markets reprice expectations simultaneously. Credit agencies have already begun quietly raising concerns about risk concentration. Economists warn that a sharp pullback in AI investment could drag down broader economic growth, especially in the United States, where AI-driven capital expenditure has become a major contributor to GDP expansion. And there's another layer most discussions ignore: governance.
OpenAI occupies an unusual position: enormous economic influence combined with private control and limited public accountability. Decisions made by a small group of executives now influence capital flows, labor markets, energy demand, and national competitiveness. That's an extraordinary amount of power for a single organization, especially one operating in a space where regulation is still years behind reality. Governments are now scrambling to respond, not just to AI's capabilities, but to its economic gravity. Who controls access? Who sets pricing power? Who absorbs the downside if growth stalls? None of these questions have clear answers yet, and history offers some uncomfortable parallels. Railroads, telecommunications, the dot-com boom. In every case, the technology was real. The transformation was genuine. The mistake was assuming innovation alone guaranteed sustainable profits. The most dangerous phase isn't the collapse, it's the moment before it. The phase where confidence remains high, warnings are dismissed as pessimism, and extreme risk becomes normalized. That's where OpenAI stands today. Its success would validate an entire generation of AI investment. It would prove the gamble was worth it. But its failure, or even a sharp deceleration, would reveal just how much of the current boom rests on expectations rather than cash flow. So the real question isn't whether OpenAI can build powerful AI systems. We already know it can. The real question is whether the global economy should have allowed so much dependency to form around the future performance of a single, privately controlled company. Because when belief replaces balance, even progress can become a liability. Thanks for watching. What are your thoughts on OpenAI and the AI investment boom? Do you think this ends in sustainable growth or a painful correction? Let me know in the comments below. And if you found this analysis valuable, be sure to like the video and subscribe for more deep dives into the forces shaping our world. I'll see you in the next one.